What impact do required minimum distributions have on your retirement? You've got questions and we've got answers. You worked hard to build up your retirement savings, but you can't keep your money in your retirement accounts forever. However, thanks to the recent Secure Act, if your 70th birthday is July 1st, 2019 or later, you can delay taking withdrawals until you reach age 72. For each year after your required beginning date, you must withdraw what's called your required minimum distribution, or commonly referred to as RMD, by December 31st. Since there always seems to be questions regarding RMDs, let me take a moment and answer some of the most common ones. Now, before I dive in, let me tackle one of the most common questions that I receive regarding RMDs, but more specifically for this year. Do retirees have to take RMDs from retirement accounts in 2020? The short answer, no. All RMDs have been suspended for 2020. This waiver includes any retirement accounts subject to RMDs, such as IRAs, TSPs, 401ks, 403bs, and inherited accounts. Now on this, if you are subject to RMDs, the waiver applies to you regardless of age. It includes original account owners over the age of 70 and a half or 72 under the Secure Act, original account owners who turned 70 and a half in 2019 but have not taken their distribution yet, and inherited IRA beneficiaries at any age. Okay, so let's look at those popular questions. Number one, are there consequences for failing to take your RMDs? The answer is yes. If you are required to take a distribution from your retirement account and you do not, or if the distribution that you take is not large enough to meet the required minimum, you may have to pay a 50% penalty on the amount that you did not take as required, which would be imposed by the IRS. Question number two, how much are you required to take? So the RMD for any year is the account balance at the end of the immediately preceding calendar year divided by a distribution period from the IRS's Uniform Lifetime Table. A separate table is used if the sole beneficiary is the owner's spouse, who is 10 or more years younger than the owner. If an account owner fails to withdraw the full required amount, the penalty may be waived if the account owner can establish that the shortfall in the distribution was due to a reasonable error and that reasonable steps were taken to remedy the shortfall. Number three, when exactly do you need to start taking your RMDs? Well, let's first look at IRAs, including SEPs and simple IRAs. If you were born before July 1st, 1949, RMDs are required April 1st of the year following the calendar year in which you reached age 70 and a half. However, if you were born after June 30th, 1949, you would need to take your RMDs April 1st of the year following the calendar year in which you reached age 72. I know this gets confusing. When it comes to TSPs, 401ks, 403bs, profit-sharing plans, or any other defined contribution plans, you generally need to begin taking RMDs April 1st, following the later of the calendar year in which you either reach age 72 or age 70 and a half if you were born before July 1st, 1949, or when you retire, and that's if your plan even allows it. And question four, how is an RMD taxed? The account owner is taxed at his or her ordinary tax rate on the amount that was withdrawn from the RMD. However, to the extent that the RMD is a return of basis or qualified distributions from a Roth IRA, it is usually tax-free. Additionally, RMDs cannot be rolled over into another tax-deferred account in an attempt to push back or defer the amount. One more note. When it comes to your RMD, you can withdraw more than the minimum, but you need to keep in mind that your withdrawals will be included in your ordinary taxable income, except any part that was previously taxed or that can be received tax-free. So as you can see, The recent Secure Act changes are bringing up a lot of tax questions about RMDs, and we are happy to help clear up any of the confusion. When it comes to contributions or anything tax related, as always, it's best to speak with your tax advisor for more clarification on how this pertains to your individual situation. Finally, the IRS has put together a great resource webpage that answers these questions and a whole lot more. And it can be found at the link below. If you should have any further questions, please reach out to us anytime.